Good afternoon, traders. This is the Daily Trader here on the Schwab Network. I'm Tom White, filling in for Kevin Hinks. We got a couple of names to look at that have been in the headlines, the AI darlings. We're going to lead it off here with an example trade in Nvidia. Shares are actually relatively flat. We're hearing a lot of tariff talks today, but also the administration's putting more chip restrictions on 80 different organizations, most of those in China. That's negatively impacting Nvidia, and that's on top of the restrictions that they already have. And then Chinese server maker H3C warned of depleting inventory of Nvidia's H20 chip. Those aren't the high-end chips that can be sold here in the U.S. Those are the low-end chips, and they're still running into supply issues with those. So we're going to get into an example trade here. Stock is down about 26% from its all-time highs that it hit at the beginning of January of about $153 per share, down about 16% in 2025. So the stock's been under pressure, still up nearly 300% from levels 3 years ago. So take that into context when you look at Nvidia. 1-year chart, really choppy, really volatile. 3-year chart looks pretty good for long-term investors. But we wanted to look at a strategy that takes advantage of higher implied volatility levels with the thought, and I think investors and traders have this thought, when can I get into Nvidia? I missed maybe the first run up from 2 years ago, but I want to get into this stock. Well, here's a strategy that might help you out with that while giving yourself a cushion to the downside, taking advantage of higher implied volatilities if you want to own the shares or if you just want to collect some elevated option premium. So we went out to the April 17th monthly cycle. So 21 days to expiration on this one, kind of short-term positioning on it. And what we're going to look at is selling a cash secured put, right? This is a naked put. You're selling the 110 strike put in the April 17th monthly option series. You're going to collect roughly about a credit of about $3.70. That's what you can make on this position, $370 per share if the stock remains above the 110 strike into expiration, right, over the next 3 weeks. Now, this is a type of trade that's kind of twofold. If you collect that 370 credit on it, that's what you can make. It takes your break even on this one down to 106.30 over the next 3 weeks. That's about 5 to 5.5% below the current share price of around 112.50 in Nvidia. So take that into consideration. I mentioned it's twofold type of trade. You either want to keep that option premium you collect because you think the stock's going to remain above 110, or you're comfortable if the stock continues to fall, goes below 110, you're comfortable owning the shares because you collected 370 credit. Your trade price on that of buying the shares is going to be 106.30 to the downside. And as I mentioned, that's over a 5% cushion to the downside. Now, let's talk about risk reward. I mentioned the reward. You can make $370 on this trade, but your potential risk is $10,630 per contract that you sell because you have risk if the stock were to somehow go to zero. So you've got to take that into consideration. It's a higher capital or higher margin type of requirement used on this. Now, this is one of those strategies you can use over and over again if you think the stock's going to continue to stay above a specific strike that you sell, or it might be one of those strategies that you use. Say you put in a bid for Nvidia at $106.30 for the stock, right? And it never gets down there, and then you've missed your opportunity if the stock went up. Well, a cash secured put takes care of that for you where, hey, even if it doesn't go down to 106.30 and I sell that cash secured put at 110, I collect $3.70, my break even to the downside where I start losing money, 106.30, I still get to keep that credit that you collect on this particular trade. So keep that in mind, but taking advantage of higher implied volatility, putting a base in where if you think it's not going to fall below 110 or you're comfortable owning the shares at an over 5% discount to where they're currently trading, this strategy may work out for you. All right, now let's get into a discussion about another stock that's been in the news quite a bit, and that's Oracle, another AI darling. Now, this stock is also off over 25% from its all-time highs recently. We've seen a pullback in tech, and Oracle's not immune to that. Shares are down about 12% so far in 2025. President Trump said, on Wednesday is willing to reduce tariffs on China to potentially get a deal done for TikTok, right? And Oracle is in the crosshairs there. Oracle stated earlier they're considering a proposal for a sale of the U.S. operations at TikTok that would provide security assurances, taking a small stake in TikTok on this company. So it's been in the news quite a bit, but pulled back in bear market territory, right? Anything more than 20% off its recent highs is considered in bear market territory. We've seen a lot of tech names in that. So I looked at a different strategy here. If you wanted to be a little bit more aggressive with Oracle, you think the market's going to rebound, you think Oracle is going to rebound, this type of strategy may provide some profitability if that does take place. So implied volatility levels, they're elevated, but not that much, right? But I want to use a strategy where I can offset some of my costs on this bullish position by doing a vertical as opposed to just buying an outright call or buying the stock in general. So going out to that same April 17th monthly cycle, so 3 weeks to expiration on this one, we're going to buy a call vertical. We're going to buy one of the 146 strike calls and sell one of the 152.5 strike calls. So a bullish $6.50 wide call vertical to the upside on this one. And you're going to pay roughly a debit of about $2.70 on that. So your break even, if you pay $2.70, that's your risk, right? $270 per spread. If you pay $2.70, it takes your break even up to $148.70 over the next 21 days. That's only about 2% above the 146 strike price, right? So you don't need a monster move to the upside. You want that grind up over the next 3 weeks on this type of strategy. Risk, as I mentioned, about $270. If it does go above 152.5 by expiration, your profitability about $380. So this is still a bullish stance, like we looked at the Nvidia, which is more passive, right? Neutral to bullish. This one is more aggressively bullish where, hey, I think that Oracle may continue to rise or may bounce off of these lows that we've seen, get out of bear market territory. This strategy takes advantage of it. So doing the vertical as opposed to maybe just buying the 146 strike call, it reduces your initial price on it, and that's your risk, right? The price you pay, $270 debit, is your risk on this. So that's one of the considerations when doing bullish or bearish type of positions, directionally biased positions when you're actually taking a debit, is can I sell something against the initial purchase of the 146 call? We went up to the 152.5 strike call, offsetting some of those initial costs on this bullish trade, but you definitely need the stock to move higher, about 2% from the 146 level. All right, that's going to wrap up the Daily Trader here on the Schwab Network. Be sure to tune in 24/7 on schwabnetwork.com. Download the app. We'll be there.